right now it's looking like there's a huge difference between large national banks like Wells Fargo, Bank of America, JP Morgan, and so on, and regional banks, which only service a small area. And the biggest difference comes down to how well they've diversified their portfolios. For national banks, it's become very apparent that they are flush with cash. They've been stress tested to withstand a 33% drop in commercial real estate prices. On top of that, it's also worth mentioning that these large banks have the resources to absorb any sort of losses from within the market. And even if something did happen, they're mostly deemed as too big to fail by the Federal Reserve. On the other hand, smaller banks do have a lot more exposure to commercial real estate, and even though some of those losses might not be the end of the world, it is expected that these banks are going to be a lot more cautious about who they lend money to, and people are going to scrutinize their loans a lot more closely than they did in the past. However, in terms of whether or not these loans are anything to be concerned about, Moody's just went on record to say that the banking system and private credit markets are sound, and that one cockroach does not a trend make. I'm sure they meant to say doesn't make a trend. Anyway, in terms of banking failures, they also said that default rates on high-yield debt this year has been relatively low, holding under 5%, and are expected to drift down below 3% in 2026. By comparison, during the 2008 financial crisis, defaults on high-yield debt were in the low double digits.